Hi, and welcome to another presentation from your business tutor, learning your way, anytime, anywhere. Although many brands start out with a single product, most such as Heinz and Coca-Cola now provide a range of items which they sell to customers. So with that point made, let's introduce today's topic, which will look at product portfolios. Okay, so what are we going to learn in this presentation? Well, first of all, we're going to find out what a product portfolio is. Then we're going to investigate how the Boston Matrix is used to classify product portfolios. And then finally, we're going to explore the advantages and disadvantages of a product portfolio. Okay, let's get started by asking, what is a product portfolio? A product portfolio describes a situation where a business offers a range of products to customers. In some circumstances, the range will be connected to the same industry and are referred to as a product line portfolio. For example, Coca-Cola's product portfolio is in the soft drinks industry. However, other organisations have what is called a diversified product portfolio, meaning their range of products are sold across several industries. For example, Virgin operate in media, transport, leisure and financial services industries. Okay, let's now move to find out how products are classified within a portfolio by asking, what is the Boston Matrix? The Boston Matrix is a tool managers can use to classify and analyse the products in their portfolio into 4 different categories, referred to as cash cows, stars, question marks and dogs. How this is done is by initially identifying the growth rate of each market or industry its products are in. For example, are they growing in size rapidly, slowly or not at all? After this, a business will then look at how each of its products are performing within those markets compared to their competitors by identifying what each product's market share is. From here, a business can then create a Boston Matrix as shown, into which it can classify each of its products based on how quickly the industry its products are in are growing, displayed at the left hand side of the table, and then by what market share each product has in those industries, shown at the bottom of the table. For example, in markets which are growing in size rapidly, products can be classified in 2 ways based on the market share they hold in those markets. In that, as product A has a high market share, it is classified as a star. Whereas, as product B has a low market share, it is classified as a question mark. But equally, if a business has products in industries which are growing in size slowly, 2 further classifications can be made. In that, if a business's product has a large market share, as product C does, it will be termed a cash cow. Whereas, if it has a low market share, which in this case describes product D, then it will be classified as a dog. However, as useful as it is to categorise products in this way, the real value of the Boston Matrix is in the idea that it helps a business decide how it should support each of its products. For example, if a product is classified as a star, it tells a business they should invest heavily in not only developing their product to keep it fresh, but also in advertising it so that it forms a brand identity. If this is done successfully, the business's product will not only maintain its market share in a growing industry, but eventually will become a highly profitable product. This is because although the measures are initially expensive, they help a star product build a band of loyal customers, meaning once the market begins to slow and stabilise, less financial support will be required to maintain their market share, meaning substantial profit will be easier to generate. In fact, and as you may already have worked out, once the growth rate of the industry the star product is in begins to slow, it will be reclassified as a cash cow. However, before going on to look at cash cows, it is probably more useful to look at question marks first. In that, like star products, they are in a fast-growing market. However, in this instance, their sales are disappointing. This creates a real conundrum for a business. Because with such a weak product, they have to decide if it is worth investing in it to try and turn it around, given the growth potential in the market is so good, or whether they are better to cut their losses and end the product. Whichever decision is made, it should be based on findings from market research into the likelihood of a positive or negative outcome being achieved. For example, if a positive outcome is believed achievable, a business may spend heavily on promotion to raise interest in the product, but also may reduce its price to attract sales. The hope being that the product will transform into a star and eventually evolve into a cash cow. Now, at this point, it is probably worthwhile addressing an issue that may be bothering a few of you, as it nicely connects to the next type of product we'll be looking at, which is a cash cow. In that, thus far, it has been suggested that if a star product is to remain popular or a question mark is to become successful, that substantial investment will be necessary. However, this obviously creates a problem, as financing such investment is not easily done unless a business has access to lots of cash, which of course is where cash cow products come in. This is because, as a successful product in a mature market, a cash cow is not only extremely profitable, but also generates a huge amount of cash. Better yet, as such products already have a brand identity and a loyal following of customers, very little investment will be required to maintain their market share. As a consequence, the monies such products generate can be diverted into supporting the growth of stars and question mark products. What this shows, and this is a key point, is that it is vital that a business has a well-balanced product portfolio, in so much that without any cash cows, a business will not be able to finance its stars and question marks. But equally, without stars and question marks, a business won't have any products to replace cash cows that eventually will fall into decline and die. As such, in an ideal scenario, a business would have a balanced product portfolio as shown. Nevertheless, although such a product portfolio would be great, as the business has no products classified as dogs, we also know that in reality this is unlikely. In that, if a business fails to support any of its products, fashion changes, or competitors offer something superior, a business will experience a dog, an uncompetitive product with a declining market share in a stagnant industry. In short, a product which a business should kill off or sell to a competitor before it becomes unprofitable and a drain on cash. Okay, let's now turn to look at the advantages of having a product portfolio. One of the big advantages of having a product portfolio is that it spreads risk. This is because if one product in a business's range falls into decline and becomes a dog, it will have other products which it can fall back on to keep the organisation going, as they will still be generating profit. In fact, this advantage can be particularly viable if the business's product range is diversified across a number of industries, as it is highly unlikely they will all fall into decline at the same time. A second benefit of providing a wide range of products is a business can tap into high growth industries and market segments where profits are easier to make. Better yet, by operating across so many industries, a business's brand name becomes better known, as it will be available in more stores and locations, which of course can help sales. But more than that, brand recognition also helps customers when buying a product they have not purchased before, because if they have used one of the brand's products previously and trust its quality, it will persuade them to purchase. In fact, this benefit can be particularly useful when a business is launching a new product, as it can use the branding from its existing range to create a strong launch for its new product, which will boost sales. Another advantage of having a product portfolio is that seasonal fluctuations in sales can be ironed out. This is because if a business only had one product that sold well during the winter, it would struggle at other times of the year. However, if it had a range that did well during different times of the year, its sales would be far more even, making it much easier for the business financially. And finally, having a wide portfolio of products makes it easier for a business to finance its operations, in that the profits generated from cash cows can be ploughed back into the business to support the development of stars and question marks without having to use expensive forms of finance such as a bank loan. Okay, let's now turn to the disadvantages of having a product portfolio. Probably the biggest disadvantage of having a product portfolio is the cost involved in not only developing so many products, but also promoting them as well. This is especially the case when it comes to question mark products, because if their low sales and market share cannot be reversed, they will evolve into dogs and have to be killed off. This, as you can imagine, would be a nightmare scenario, as the losses generated by such products would weigh heavily on the financial position of a business and prevent future investment in new products. Another issue with having a product portfolio can occur when a business sells two products that are targeting very similar segments and customers, in that each product can steal or cannibalise sales from the other, meaning a business ends up competing against itself, which isn't good for organisational culture and unity. And finally, bad publicity around one product, for example because of quality concerns, can have a negative influence on the whole product range, meaning sales will fall dramatically. Okay, so what did we learn in this presentation? Well, first of all, we found out what a product portfolio is. Then we went on to investigate how the Boston Matrix is used to classify product portfolios. And then finally we explored the advantages and disadvantages of a product portfolio. If there is one phrase that summed up the value of having a product portfolio, it would be, don't put all your eggs in the same basket. This is because relying upon a single product is an incredibly risky strategy, as it only needs one thing to go wrong for a business to fall into a financially fragile situation.